Most people don't realize this until it's too late. But once you own 10 finance properties, the bank literally tells you you're done. No more conventional loans, no matter how much income you make or how perfect your credit score is. So how is that some investors own 20, 30, or even 50 properties? It's not luck, it's a loan hack that banks don't advertise. And today, I'm going to show you exactly how it works. If you're serious about investing, this matters because the day you hit that 10th property limit, you either stop growing or you learn how to play the smart game. The good news, there's a way to keep expanding your portfolio without relying on traditional financing. It's called a DSCR loan. And it's the tool most seasoned investors use once they max out their conventional options. If you're new here, welcome to the Mortgage Cafe with Angelica, where we sip on coffee and talk all things homeownership, investing, and smart money moves. I'm Angelica Obregon with Key Mortgages, and my goal is to help you understand how to use real estate to build wealth, strategically, not stressfully. Don't forget to like, subscribe, and comment below if you're working on your first or your 10th investment property. Let's start with the rule that nobody warns you about. Fannie Mae and Freddie Mac, the agencies that back most conventional loans, cap you at 10 finance properties under your personal name. That includes your primary home, your second home, and even rental properties that still has a mortgage. So once you hit that number 10, you're done with conventional financing, no matter your credit score, your DTI, or your income. And trust me, a lot of investors hit that wall fast. Why do banks care how many properties you own? Simple, it's risk management. The more homes you finance, the higher the risk for the lender. If the economy dips, they assume you'll protect your primary home first and walk away from the investment properties. So Fannie and Freddie created a limit, 10 finance properties max, to reduce exposure. But that rule only applies to conventional loans that are backed by those agencies. And that's where the loophole comes in. Here's the good news. The 10 loan limit does not apply to DSCR loans. DSCR stands for Service Coverage Ratio, and it's a type of non-QM or non-qualified mortgage. Non-QM loans don't rely on Fannie and Freddie guidelines, which means no property limit. You could own 10, 20, or even 100 finance homes and still qualify, as long as the property itself has cash flow. Let's break it down simple. DSCR loans qualify based on the property's rental income, not your personal income. The lender looks at how much rent the property brings in compared to its monthly mortgage payment, including taxes and insurance. If the rent covers the payment, usually with a small margin like a 1.00 or higher, you qualify. No pay stubs, no W-2s, no tax returns. Just the property's ability to pay for itself. That's the power of the DSCR loan. If this is helpful so far, hit that like button, subscribe, and comment DSCR below if you're ready to learn how this strategy can work for you. Now, here's why this strategy is such a game changer. There's no limit on finance properties, so you can keep scaling past 10. You close under your LLC for asset protection. There's flexible loan terms, 30-year, 40-year, or even interest-only options for maximum cash flow. There's faster closings because there's less documentation and no waiting on personal income approvals. And for experienced investors, that's everything. You can move quickly when deals hit the market, and speed is what separates good investors from great ones. Let's compare the two side by side. Conventional loans. They're backed by Fannie and Freddie. You have a limit of 10 finance properties. It requires full income verification, slightly lower interest rates, but heavy paperwork. DSCR loans. There is no property limit. You're qualified based on rental income. You can close under the LLC or personal name. Slightly higher rate, but faster approval and no tax return headaches. The trade-off is simple. You pay a little more in rate, but a lot more flexibility and growth. Now, here's how real investors scale using this combo. They start with conventional loans for the first 10, taking advantage of the lower interest rates. Once they hit that limit, they pivot to DSCR loans to keep expanding their portfolio, often using cash-out refinances or HELOCs from earlier properties to fund down payments. It's a rinse and repeat cycle. And that's how investors go from 1 to 10 to 20 properties without even running out of options. Now, like any tool, there are things to be mindful of. DSCR loans usually require 20 to 25% down, and interest rates can be higher than conventional loans. But remember, for investors, it's not about the rate, it's about the return. If the property cash flows and appreciates over time, the loan pays for itself and building long-term wealth. That's how the pros think, and that's how you should be thinking too. So if you've been told you can't buy more properties because you've maxed out your conventional loans, that's not the end. It's just the beginning of the next level. Visit mykeymortgages.com or click the link below to subscribe your free strategy call. And let's talk about how to grow your portfolio using DSCR loans. And that's your sip of wisdom from the Mortgage Cafe with Angelica, where we turn home ownership into wealth, one key at a time. And remember, this is Angelica with the Mortgage Cafe, serving Florida and Georgia. I'll see you next video.